Good afternoon, and thank you so much for joining us. My name is Sandeep Dahiya. I've been a faculty member here at Georgetown's McDonald School of Business for over 20 years now, and currently hold the Akavi Associate Professor Chair in Entrepreneurship and Finance. My research focuses on corporate finance, banking, corporate governance, and venture capital. And I'm delighted and honored to introduce our distinguished speaker, as well as our moderator. Stacy is our distinguished guest. She is the president of NYSE Group. Stacy is the 67th president of this great iconic institution that has played such a central role in our country's history and business. She's the first woman to lead the NYSE Group in its 227-year history. And most recently, she was the NYSE Chief Operating Officer, where she was responsible for New York Stock Exchange's 5 equity markets, 2 option markets, leading the company's strategy for its equities, equity derivatives, and ETF businesses. Prior to serving as the CEO, Stacy was the president of NYSE Governance Services and served as the head of sales and relationship management in NYSE. And before joining the New York Stock Exchange, she had had several senior positions at NASDAQ. As you can see, Stacy is eminently qualified. Her achievements are far too numerous to count. I just wanted to point out it's only fitting that she started her career at NYSE and she is leading that organization now. She earned her BS in Industrial Engineering from Lehigh. It gives me great pleasure to welcome Stacy to this fireside chat session, which will be moderated by Bob, who also needs introduction. He's the co-founder and CEO of Cohen and Steers. He's our own. He's a Hoya. He's a GU parent. He's chairman of the McDonough Board of Advisors. Bob's, your contribution and your help to this organization are much appreciated. And I welcome you to lead this session. I'm going to pass it on to you. Thank you, Bob. Thank you, Stacy.
Great. Thank you, Sandeep. And Stacy, welcome. Thank you for joining us today. In our short 30-minute time that we've been allotted, we're going to try to address 3 pretty major broad areas. One is the impact that capital markets have on and the responsibility capital markets have to society. Second, how new technologies and new innovations regarding capital formation are impacting the New York Stock Exchange and more broadly all exchanges. And then we're going to turn to some recent trends, such as was mentioned in the prior panel, the recent spike in retail volumes, operating in the COVID environment. Stacy's had to be pretty innovative there. And some of the new avenues that are being taken to get public in today's environment. So the first question I have for you, Stacy, is relates to the concern and contention that the strength in the sustained strength in the equity markets now for almost a decade has helped to widen income inequality in our country. And I have a couple of questions all related to that, which is, 1, do you agree with that? 2, should public capital markets and exchanges help to address this issue? And if so, how?
Thanks, Bob. And thanks again for having me back here today. I'm excited to be joining. And it's a great question because I think there's so much when you think about our capital markets, the value that they contribute. And I think there's a lot of things that are often misunderstood. But that said, given the evolution of what's been happening over the past several years, there is definitely an equity divide, right? And there is definitely an income divide. And if you think about what our mission is at the New York Stock Exchange is to help companies raise money so they can go out and change the world, but also provide an opportunity for investors to share in that success. And that second part of it, we can't ever lose sight of, right? So they're providing opportunities for investors to plan for their future. They're creating jobs along the way. But if companies are staying private longer, it means that investors are not necessarily sharing in that rapid growth. So one of the important things, and we've certainly seen this, is that as the markets continue to provide more infrastructure and stability and investor protections, which are all really very useful, they also mean it's a little bit harder to be a public company. And so companies are waiting a little bit longer to become public so they can have the full, scope and teams that can handle that process. And there are alternatives. They can raise money in the private markets. So we've seen the amount of private capital that's available and accessible really drive a change in behavior to companies waiting longer because they do have alternatives. And that's a real shift. I mean, historically, when a company was going public, the primary reason was to raise money. And then their secondary, tertiary reasons were things like having liquidity for their employees or having a currency so they can engage in M&A. Or just the credibility and visibility of a public listing. Because they have so much access to private capital, they're waiting to go public until those second or tertiary reasons become their primary reason. So you see a lot of the tech companies that have been paying employees in equity and options for a very long time. Now, if they're 10 years old, their employees want to be able to go buy a house, or they want to be able to use that equity that they have. So that's really what driver for going public. Now, 2020 really led to a shift in that dynamic. It's hard to believe, but this year has been fascinating in so many ways because you've seen that companies that weren't public in the height of the pandemic had to actually raise money at a much higher cost in the private markets. The public markets were there for companies whose businesses were suddenly impacted by the pandemic to raise money. We've raised over $160 billion across the companies listed on the New York Stock Exchange this year. And a lot of that was airlines, hospitality companies, retailers that were looking to raise money during the height of the pandemic. What that shifted to was now private companies coming off the sidelines. And so we've seen a lot of companies. This has been the busiest IPO year on record. I mean, September was the New York Stock Exchange's record month for IPOs in our entire history, which, as we know, goes back a long way. And then October eclipsed that record. And so we see that shift. That's important because it does contribute to closing that wealth gap if we can get companies public sooner. So we've seen a lot of innovation in that space, but getting companies out to the market sooner is important. I heard somebody speaking about private investment in pre-IPO companies for wealth advisors, for significant high net worth wealth advisors. And that contributes to that problem that you talked about. If people are investing in the private markets and not everybody has that access.
So it sounds like what you're saying is that the more companies that are public that provide more optionality for capital raising, whether it's for companies that in the COVID world are cyclically depressed and may have difficulty maintaining their workforces and so on, having more access and more options actually could help to some extent at least mitigate.
Getting them public sooner in their life cycle. You look at a company like a Salesforce who has seen an increase of 5,600% since they went public. That meant the everyday investor can share in that success. Look at Amazon. Amazon went public. Its market cap was $450 million roughly. Certainly, it's eclipsed the $1 trillion mark. So having that growth happen where everyone has access to it is really important. We talk a lot about making a difference in the world. And so very often the big business and financial markets are sort of held out there as capitalism is often viewed as a negative thing sometimes, and it's described as makes the rich richer. And it's less about making the rich richer, but providing access to that opportunity and that growth in the public markets actually provides that to everybody. And so as we talk about asking businesses and CEOs to think about stakeholders beyond their shareholders, that this is what I'm talking about, right? Like this does that. If they're bringing their companies public sooner, they're actually thinking about the overall community, because it's okay to grow a business and become a billionaire if you've really created value and delivered value, but it's a story of shared success. If it's no longer a story of shared success, you're going to see people challenging that model.
Just last follow on this. Do you find that any of the issuers or their bankers have this issue on their minds as they go from private to public, and or is this really not?
Well, I've been trying to put it on their minds because, and it's not just because I run the New York Stock Exchange. Certainly, we can build our footprint in the private market space as well. Where I think it's important is to recognize that value. Another dynamic of conversation that we're seeing happen between issuers and their bankers and others is how they go public. So that's something that's changed, and 2020 has certainly seen more innovation this year and more companies choosing other paths. Because companies are bigger, they're actually now asking questions about, wait a minute, if raising capital isn't my primary goal, how, do I need to do an IPO to become a public company? Right. If that's not what I'm pushing for. So that was the genesis of the direct listing, which Spotify started asking that question a couple of years ago. They went public. They didn't do a capital raise. They just said, I want to be a public company, but I'm not doing it to raise money. So I'm going to let the New York Stock Exchange actually price my offering. It wasn't an offering, price their first public trading day. Slack followed suit. And then we had 2 direct listings in September through Palantir, as well as Asana. Both chose the direct listing model. Actually, on one day in September, we had 2 direct listings, 2 SPACs, and 2 IPOs. So I think that's what we're going to see going forward. We've also seen a number of companies choose the SPAC route as an alternative way to go public. Each one of these routes provides their own set of benefits and trade-offs. And so companies have the right to have that conversation with their bankers and their advisors about what makes the most sense for them. And they're playing a different role, whether they want more control or a faster time to market. They might choose a SPAC. They're negotiating with one counterparty. They have a little more control over that whole process. They might choose a direct listing if they want to reduce their cost of capital and let the market forces price their offering. And so we're introducing the ability to offer primary shares as part of a direct listing. And then an IPO gives them the ability to work with their bankers through a more traditional process, have more conversations with investors on their roadshow and take that approach too. So there's some stability with that. And so companies are making those choices now. And I think the banks are supportive of them through this process. We certainly are too. I mean, it makes sense to innovate in the capital markets.
Well, the IPO market, it was a topic I was going to save till later, but now that you've wandered into this space, I did want to recognize that we have seen, I think by a wide margin, a record number of SPACs this year and counting. It's still a bit of a head scratcher to me. And of course, as you just pointed out, direct listings are on the rise, and I believe that the SEC is considering a more formal approval of direct listings or direct IPOs. And just maybe go into a little bit more, beyond just what's in it for the issuer. Will this become the new normal, do you think? What are the pros and cons of getting public through SPACs or direct listings as opposed to more traditional approaches? And what if anything is the New York Stock Exchange doing to recognize these changes?
So a number of things. I mean, one with respect to SPACs, I mean, you're right. 40% of IPO proceeds this year have been through SPACs, which is really unprecedented. Yeah. And SPACs, which stand for Special Purpose Acquisition Corporations, are an alternative way to become a public company. So a management team launches a SPAC. They IPO the SPAC without having a business operation. So they raise money with the intent of acquiring a business, and they'll indicate at the time of the IPO what type of business they're going to acquire. And then once they identify that business, at the time of the business combination, that's how that private business becomes public.
But it's essentially a blind pool when it first is created.
Yes, you're really investing in the management team and saying, hey, I think these people are going to go identify a company, and I'm investing in that. Now, it's a pretty low risk investment. And the reason why is you have a number of times where you can get your money back. You have a number of times where you can vote on whether or not you like the business combination. And when a management team launches a SPAC, they have 2 years to go identify the company that they want to buy. At the time that they do, they come back to those investors and say, this is what we're going to buy. And investors can vote yes or no, and they can redeem their money and get their money back in full if they don't like it, which is why the SEC got comfortable with it. Right. Now, historically, SPACs were a way to to become a public company of last resort. It was if you couldn't do an IPO on your own, you might be able to find some questionable, way to get public via a SPAC. And you would, in exchange for that, pay a very high fee, sponsorship fee to those launching the SPAC. And so it really brought a lot of companies back that weren't necessarily public company ready. So it had a pretty negative connotation to it historically.
Yeah.
Now we have some of the best minds in business launching SPACs. They're successful CEOs, they're successful money managers, and they're evolving the economic model around sponsorship. Bill Ackman launched a $4 billion SPAC. Pretty. It was the biggest IPO this year, was a SPAC, which it says a lot in itself. And he started to change the sponsorship model. So we're starting to see a lot of evolution in the SPAC. So they're certainly not what they were before. Now, that said, there are a lot of SPACs out there, and they're all looking for a business combination to get done, and they're all on a clock to do so. So there is some risk of that. They're not all going to be as successful as others. And while the investors in the SPAC may have a limited amount of risk because they can get their money back and vote on these things, there might be incentives to get a company public quicker. That we want to make sure investors are still doing their diligence on the company. They still go through the filing process. They still have to meet the NYSE's listing standards and all of those elements. They're not one of the advantages to a SPAC, which is why some of the more complicated companies are preferring it, is they can provide forward-looking guidance. So a company like a lot of the electric vehicles are choosing the SPAC method because they can say, we're not profitable yet, we don't have revenue yet, but this is where we're going to get and how we're going to get there. And you can't do that through an IPO process. So it gives them more forward guidance that they can deliver.
So would you consider SPACs the new normal? Or, SPACs have been around a long time. They've sort of, they've enjoyed success and then hit a wall, gone away for a while. Now they're back in a big way. And so I guess I would ask, what do you think is more sustainable? The changing regs regarding just direct IPOs or direct listings versus a SPAC?
I don't think I don't think either one of them become the way of the future. I think there's a place for all three of them, and I think they achieve different goals. If somebody has a more complicated business and they want to provide that forward-looking guidance, and they want more control of negotiating with a single counterparty, but then let the market decide once they're already public, now all of a sudden the market might reprice that valuation based on everything that's out there once they already are public, then a SPAC might be right for them. If they have a business that they feel like they can explain through their investor day on an investor roadshow, and they want the market to decide its valuation as they go public and just maximize, if they're confident in their story and they believe that investors more broadly, direct listing, what it does is it really democratizes access to the event. So when Spotify and Slack went public, they were really the first couple of companies to choose that method. Spotify was a household name. So it was, that was one of the ideas that people thought you have to be a household name to do a direct listing because you need investors to understand your story. Slack wasn't a household name, and they still had a lot of successful interest. An IPO is artificially constrained for months. The night before, when the initial public offering is done and underwriters are allocating shares out to investors, not all investors have access. So they're giving allocations, and even those investors that get an allocation don't get as much as they might want. So it's artificially constrained on that demand side. And then once it becomes a public company, there are often lockups that prevent owners from selling their shares in the market for several months. So it's artificially constrained on the supply side as well. With a direct listing, we take away those artificial constraints, and the market determines the value of the company with the full information available that a public company provides. And all buyers and sellers are on equal footing. Retail investors and the most sophisticated institutional investors have access to the same information through a roadshow, not just the roadshow, but an investor day that gets broadcast and webcast out. So everyone sees the same information, and they all can enter as much interest as they want. They're not artificially constrained. And so what we saw in both Spotify and Slack, they were two of the largest opening trades of all time. They weren't the two largest companies. Slack was the third largest opening trade, and it was a $19 billion company, not that significant, but it traded $1.9 billion in just that opening auction. That's price discovery. That's real supply and demand coming together. And so you see less of a first day pop. So people look at it and they don't think, wow, this was a great successful IPO, because the market actually priced it and it somewhat stayed there.
Right.
But that first day pop isn't so great if you're the one that sold it the night before. And that's what companies are challenging. Hey, I sold shares. Snowflake was the largest software IPO ever when it went public on the New York Stock Exchange in September. And they raised $3.5 billion. Their stock popped $4 billion the next morning. So in 18 hours, whoever bought the night before saw over 100% return. And I think that's the impetus behind a direct listing is why should it be that way? What did they do to deserve 100% return in a few hours? And so, when companies were much smaller and they were going public, underwriters were asking their customers to take some risk on an unknown company that was growing. Now, many of these companies are larger, well-established companies that are widely known. Uber is widely known, already had public money invested in it in the private markets. So looking for that first day pop seems to be a bit antiquated. And that's the innovation that we've been driving at the NYC. We worked with Spotify for a year and a half on developing the direct listing. We're working with the SEC now on adding a capital raise to it so you can actually sell shares at the same time. We changed our listing standards. You talked about SPACs of yesteryear. We actually didn't list SPACs on the New York Stock Exchange because we were concerned about some of the elements of that. We adjusted our listing standards a couple of years ago, and now the vast majority of SPAC proceeds is raised on NYSE because we put in other structures around it that has drawn a lot of companies to the New York Stock Exchange. So innovation is important, even in capital markets, even how you go public. So we're excited by what we're seeing, but I do think that in the future you're going to see a mix of all three of those ways. Each path to public will be used.
That's really insightful. Thank you. I'm gonna shift to a topic that the prior panel hit on, which was the combination of frictionless trading through the Robinhoods of the world and COVID has resulted in a spike in retail volumes of trading this year. I think recently retail is over 20% of daily volumes. You've had a huge increase in the percentage of off exchange volumes. Mm-hmm. Trade reporting facility volumes are now greater than 40% of daily volume. Can you just weigh in on, is this new volume of retail trading, whether it's because it's commission free or a lot of folks are at home and trading stocks instead of betting on football games. Has this impacted spreads? Has it impacted volatility? What has been the impact, if any?
So I'll start off by saying there's good and bad to it, right? And so it's great to have retail participation increase in the market, especially from a younger demographic that may not have been active in the markets. And part of that reason is back to your first point about the wealth divide and opportunities. It's great to have retail participation in the markets. And so seeing that increase, which I do agree, I think a lot of it was driven by zero commission. People were home, they had nothing else to do. And there weren't other activities that may have been a distraction weren't in existence. So we saw a lot of retail participation start to increase in the market to a point where it's the amount of off exchange trading, you're right, is over 40%. And on days when volatility picks up in the market, it can be even, it can be 45% on days when retail really picks up in the market. So that's pretty significant when we talk about how much of the off-exchange trading isn't contributing to price formation because they're not setting prices. They're not putting out bids and offers that are helping to drive what the actual price is. So when you get a lot of that off exchange, you're really masking what the underlying natural liquidity might be. So while it's really good to have retail participation in the market, we do want to be sensitive to the dynamics around market forces and also to whether or not those retail investors understand the risk of investing in the market. The fact of the matter is when there is a major market volatility event and it's one trade out of many trades that an institutional investor may make, they're going to average out over time and usually recover. Larger players have an easier recovery from a market downturn. Retail investors, if that was their wealth that was invested in that one trade, it's not so easy for them to recover. And so I think we need to be, for those of us in this industry, need to be focused on protecting those retail investors because that investor confidence is core to our market success. And we need to make sure that we're educating them and providing them with the visibility. It was really hard for me to watch retail investors panicking in the spring and selling because they saw their 401k value on paper values declining. Those values are not declining until you say sold, and so I was trying to convince them that they shouldn't panic and respond, that you should think about your time horizons. And if you have a long-term time horizon, you're best off waiting and seeing, what the trends are over time and not panicking. It's usually the worst time to sell is when everybody else is selling. So that's a bit of a concern. I think we need to be focused on that. With respect to its impact on volatility and price formation, I think a driving factor there is the amount of fragmentation in the markets. So when I started my career on the trading floor of the New York Stock Exchange, if a stock was listed on the NYC, about 85% of its trading happened on the New York Stock Exchange. If a stock was listed on NASDAQ, about 80 or 85% of its trading would happen on NASDAQ. Now, those are closer to 25%. There are 16 different exchanges. There are dozens of dark pools. Trading is much more fragmented. That's fine when volatility is really low because, the prices aren't moving so quickly. The amount of off-exchange trading isn't so bad because they're taking the prices that are set on the exchanges and matching their clients off of exchange. When volatility picks up, a lot of that off-exchange trading comes back to the exchanges and there isn't natural liquidity there. So we're much more dependent on market makers setting those prices, which means prices move more quickly. And when you combine that with investors and market participants using technology and responding to the same market signals, that's when you see those dramatic point moves like we saw in March and April, because very quickly they clear out those displayed quotes and stocks are falling really rapidly. You're seeing the market move and recover much more quickly because of the way technology and fragmentation has limited, there's no centralized pool of liquidity to absorb a major market move. So I do think the pendulum has swung too far on fragmentation, and that having fewer places to trade would help absorb some of that volatility when the going gets tough.
Do you have a personal view as to whether this level of retail activity is the new normal or will continue, or is it more of a pandemic related?
I think I don't expect it to go back to where it was before, but I think it would reduce over time. What I'd like to avoid is having it reduce because people got hurt in the market broadly and didn't understand, right? I mean, I've heard anecdotally stories that describe, hey, you should be investing in the market. My friends are all doing it and you can make 30% a day. Well, you can't make 30% a day in the market, certainly not over the long term. So that concerns me. If that's how people feel about the market, that describes a very low risk environment. And that's not, if there's a major downturn, people will get hurt. And that will end up seeing, you'd see retail subside. Like we saw in the financial crisis. Coming out of the financial crisis, the big players recover pretty quickly, but took a really long time, only until now, to start to see retail participation coming back in. And if you rewind even beyond that, the dot-com bubble, the tech bubble, we saw a tremendous retail participation. It was really the first time we saw such dramatic retail participation. But then once people got hurt, they sort of backed off for the next several years. So I'm hopeful that we can avoid that type of scenario through education and amplifying the risks associated with the market so people are not putting all their money in one spot.
Well, I see we have only about 5 minutes. I have lots of other questions, but one question I wanted to make sure that I got to relates to your personal success. As you pointed out, you've had a long career on the New York Stock Exchange, which used to be considered a man's world. So you're a very visible success story as a woman, as a leader of a major organization. And I think it would be helpful if you could share any insights, any advice you might have, particularly for the young women professionals who are listening, who are interested in financial services.
Sure. And Bob, I'm going to answer that two ways. One, personally, what my advice would be, and two, also what I think business has to do. So when we look at a lot of the issues that were really front and center in 2020 around diversity and inclusion and how we set people up for success and how we really drive real change, increasingly we're asking businesses to be part of that solution. And that's important. So we need to do that. We at the New York Stock Exchange believe strongly that diversity in organizations is driven when there's diversity at the top of the company as well. So we're tapping into our list of NYC CEOs to actually source diverse candidates to sit on boards of companies. So any company listed on the New York Stock Exchange can access our database of candidates when they're looking for more diversity on their board. Things like that. We're launching an entrepreneurship boot camp because the easiest way to be a CEO is to found the company. So we're helping entrepreneurs in underrepresented communities like Detroit as our first location and others to actually give them the tools they need to start companies. What's important though is when you are a diverse candidate and you find yourself in a underrepresented community as part of an organization, as I did when I walked onto the trading floor back in the, over 25 years ago, don't try to hide your differences. Your differences are what make you valuable. Your different perspective is what is needed by businesses. So don't try to fit in and don't try and behave the way everyone else around you behaves. Play your own game, because that is really how you deliver more value. And that's why it's important to have diversity of thought on boards and in management teams across companies. And you don't get diversity of thought if you have a whole bunch of people that look the same. So you need gender diversity, racial diversity, socioeconomic diversity, background diversity across the board to really come up with what are the ideas that we should be challenging, and how can we innovate, and how can we really change the world. So my biggest piece of advice is don't just embrace how you're different, and that's a really, really good thing. And then I would also recognize the value you're contributing, but just by being different. I mean, I started my career on the trading floor. There were very few women down there. I didn't think about my gender. I didn't go into it thinking I'm a woman and I should be different, or I just didn't give it thought. And I'm thankful for that. But part of the reason is Muriel Siebert, who was the first woman member of the exchange, she broke down those barriers. So I didn't even have to think about it because she did. And I think that's important, because anytime you redefine boundaries, you're redefining them for everybody that follows you. And that in itself, just showing up and you do you, and it really makes a difference.
That's really fantastic. And I assume that you have many more companies taking you up on your advice and offer to connect them with qualified board members and hopefully senior executives.
Yes, yeah, we've certainly seen an increase in demand, and I think that's one of the positives of 2020 is crisis helps you rise to the challenge, right? And we've seen people, it really brings out the best. I was inspired by all of the actions that companies took in the spring to actually be part of the solutions. They weren't focused on their quarterly results. They were focused on General Motors and Ford were turning their production lines into creating ventilators. All of the pharmaceutical companies started immediately working on vaccines and therapeutics, which is why we have a record-breaking time to market with a vaccine and therapeutics. And so I think all of those things are important. And similarly, they put those skills and resources toward promoting diversity. And we've seen a lot of challenging conversations happening in a way they haven't ever happened before. So while the triggers to a lot of the questions about racial and social injustice are not new, sadly, I think the response is new. That was certainly my experience as I've been talking to CEOs. They're having conversations with their teams that they haven't had. And I think we need to embrace that and not let it go.
Stacey, thank you so much. I feel like we've just scratched the surface, and I'm hoping Rena will let us do this again next year. I'm going to start negotiating for more time already. So thank you so much, Stacey.